Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And I have some exciting news for everyone today, because for the next few weeks, we're going to be doing something a little bit different with the show, putting a pause on the ongoing Becoming Buffett series we've been doing in the podcast, because on June 27th and 28th of 2017, just a few weeks from now, we're going to be having our mid-year DIY investing summit in partnership with Seeking Alpha. And it's going to be an exciting summit. We're going to have a lot of some of my favorite investors from Seeking Alpha are going to be a part of this summit, and we're going to have all kinds of topics, everything from what their favorite picks are, specific favorite investments are going forward from here, how they're shaping their portfolio for the second half of 2017, how they're hedging their portfolio in light of markets being at all-time highs, as well as how they go about identifying major trends and how do they identify companies to invest in, how do they research them, how do they make buy and sell decisions, all that stuff and more. So I hope you enjoy this preview of the DIY Investing Summit, and you can register for the summit for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com for your free registration. Well, Eric, welcome to the DIY Investing Summit.
Well, thanks, Brian. It's good to be with you today.
How are you positioning yourself for the second half of 2017? Is there anything specifically near term that you're excited about or concerned about that's affecting your decisions?
Yeah, actually, I do think that I think we've been going through an inflection point with the economy, really going back to the beginning of the year. So in terms of allocations, I used the bond market sell-off that took place in late last year into early this year to kind of maximize my bond weightings. Although we're to the point where a lot of those buying opportunities have kind of left the station at this point, there are some few selected buying opportunities in the bond market that are left, particularly the treasury market, the intermediate term, long-term treasury market. There's some good buying opportunities that are left there, but I really think that the second half of 2017 is going to be strong for the bond market. And this is despite the fact that the Fed is planning on raising interest rates, because the key to remember when it comes to the Fed raising interest rates, it's only bad for the bond market if the economy is surging. But the economy is weakening as the Fed is raising interest rates, which implies the greater probability for a recession, which is bond bullish, stock bearish. So that leads to the second point in terms of the second half of the year, is that the high beta trade has been on the fade for months. Outside of technology, the cyclical trades have been fading for months now, and I expect that to continue at an accelerating rate. Your industrials, your material stocks, your consumer cyclical stocks, I suspect that they're going to face increasing pressure on the downside. And that is likely to place increasing pressure on the broader market, because the broader market is more correlated to those cyclical sectors. That doesn't mean that you got to rush out of the stock market, though, because, there are certain areas on the defensive side that were sold off at the end of last year and still represent good opportunity. So you're talking about things like, consumer staples, particularly food stocks, selected food stocks. You're talking about utilities, which have had a good run, but, are worth looking at on any pullbacks here in the near term. And above all others, healthcare. Healthcare is one area of the market that is defensive. Your pharmaceutical stocks, your medical supply stocks, even some of your biotech stocks, defensive, and also offers good value right now and good income. So those are areas of the market, the traditional market that I expect to perform well in 2017. Even if the market tops and we start to see the preliminary signs of a bear market, those are areas that I suspect will do well. And then the other is the precious metals market, gold and silver. Silver is a lot more volatile than gold, so you want to manage your silver allocations carefully. And gold's volatile in its own right, but those markets bottomed at the end of 2015. And have done a lot of really good constructive backfilling and bottom filling of what was a really difficult stretch from 2011 to 2015. And I think the trend is higher on those over the next 6 to 12 months.
Great. Man, that was good. That was good. I was typing furiously trying to get caught up. That was good. So that being the case, is there any specific investment you currently have the highest hopes for at this stage? That's still a good opportunity to get into?
I think, treasuries, if I kind of had to order them out right now, I would say treasuries is still your remaining buying opportunity on the bond side, because a lot of the investment grade spread product is already running. The same thing with munis. Munis had a pretty meaningful sell-off at the end of last year. If you want to get your muni allocation, now's the time to do it, because it's, that window is closing fast. Healthcare continues to be my most favored sector of the stock market. And that's pharmaceuticals, medical supplies, and biotech, high quality biotech, that is, not the more specialized biotech. Although you could make a case if you want to be more aggressive into something like an IBD or something like that. I don't own that myself, but that you can make a case for that.
So when you say quality biotech, would that be like Celgene's and stuff like company like large companies like that, or do you mean something different?
Yeah, your large cap biotech.
Right. Okay.
That they offer good value right now. I tend to favor the ones that pay dividends, just because that's something that I emphasize in my modeling. But Celgene would be an example of that as well. Not necessarily a buy recommendation on Celgene, but the one that would be worth looking at from that perspective. Celgene, Amgen, Gilead, those type of biotechs.
Right.
And then, an area that I always watch, because it has, and I'm not buying it right now, but I owned it into the election and was very rewarding owning it into the election. I since took all profits on those allocations long ago. But is the regional bank sector, and even some of the major banks at this point. I think the environment for the regional banks and the major banks is more constructive than it has been in recent years, and I think has potential to become even more constructive, particularly those smaller regional banks in certain MSAs or metropolitan statistical areas in the United States where the local economic profile is strong and they run a good bank. If we see any kind of further sell-off in those types of regional banks, I might be looking to get back into those in the second half of the year if what we've been seeing lately continues. But that's a little preliminary. That's maybe something down the road.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.